So now we've got the contribution margin ratio. We already know how to calculate this. So if I do the sales, I do the variable costs, I do the contribution margin short form, I do the fixed costs, and I do operating income short form. So I'm going to use the numbers they have, 675,300, 303,885. I'm going to subtract those two, and then I'm going to do the 247,610. I'm going to subtract these ones. There we go. So I'm just copying what they had there so that I can, manipulate it. There we go. What is their variable cost ratio? The ratios are always the same. Sales price divided by sales price, or sales revenue divided by sales revenue, is always going to be equal to 1. Variable costs divided by the sales price, 45. That's what we're talking about. I'm going to change this to percentage. So this is 100%. This is 45%. I don't even have to do any calculations, or very much calculations. I can already calculate this. If I subtract it, right, this is going to be 55%. Now, can I calculate it as a percentage? Divide it by the sales revenue? Sure, I can. 55%. It doesn't change anything. What is their variable cost ratio? Their variable cost ratio is 45%. This is the variable cost ratio. This is the contribution margin ratio. Suppose the company's actual revenues was $50,000 more than budgeted. So now, actual revenues is $50,000 higher. That's what they're saying. This would be now the adjusted sales. It says, by how much will operating income increase? So how much will operating income increase by? Well, if sales is increasing, wait, I'm going to put sales increases. Sales increases. If sales increases by $50,000, how much will the operating income change by? Fixed costs are not going to change because fixed costs are fixed within the relevant range. So fixed costs are not going to change. So that means the only thing that's going to happen with regards to this $50,000 is we have to calculate how much of a contribution margin we're going to have. Well, we already know the contribution margin ratio is 55%. So if I take the 50,000 and I multiply it by the 55, I can tell you that the operating income will increase by this amount, $27,500. That's what the operating income is going to increase by, exactly this amount. How do I know that? Because the only thing that changes when we change the level of activity is these three numbers. This is not going to change. It's never going to change. So all I have to say to myself is, if I have additional sales, I just have to calculate what contribution margin is going to do, because fixed costs are never going to change. And I could do the whole calculation to show you. In fact, let's just do that for a second. Let's just prove whether I'm right. We know that this is going to be the sales, total sales. We know that the variable costs are going to be the sales multiplied by the 45%. I can then calculate the contribution margin, and then I can deduct the fixed costs, subtract it here. Now let's see, what is the difference between this and the old one? I bet you it's $27,500. $27,500. Why? Because the only thing that changed was my contribution margin by $27,500. And to prove that, let's just take the difference, $27,500. Why? Fixed costs don't change. Not within the relevant range. How much sales revenue must the company earn to break even? So how much sales revenue must they earn to break even? Well, we know that we can do the formula that we had originally, right? Break even in sales revenue. So I'm going to copy this. So remember what that's going to be. It's going to be the total fixed costs divided by the contribution margin ratio. It is going to be $450,200. $200. So how much sales revenue do they have to earn to break even? That's how much they have to earn, right? That's what their sales revenue has to be. I'm going to just put it over here. So remember, we're doing sales revenue. So the next one says, prepare a contribution margin income statement to verify your answers. Well, variable costs are going to be our sales, total sales multiplied by 45%. Take the difference. This is going to be your contribution margin. Then I've got my fixed costs, which have not changed. Fixed costs are still going to be $247,610. We don't even have to do this. We already know it's going to be 0. So my operating income is equal to 0. But we already knew that was going to happen because we did the first question, 14-13, right? What is the company's expected margin of safety? Now, let's go back over here. Remember, I told you the margin of safety in units is this area between here. So it is margin of safety. Let's just put it down here. How do we calculate the margin of safety? Margin of safety is equal to the actual sales, either in units or dollars. Sales revenue minus the break-even sales. That's either in units or dollars. This is the margin of safety. Because why is it called a margin of safety? Because if I'm selling at this point, I have to lose all of these sales in units, or I have to lose all of these dollars in sales revenue before I end up in a loss position. We're down here in a loss position. Okay, so that's why that's the margin of safety. So let's copy this over. So what is their margin of safety, right? So we know the margin of safety is the actual sales. So we can do the actual sales in sales dollars. That's the actual sales, right? We know that that's the actual sales because it says this is what they had, or this is budgeted. This is what they budgeted. So here it's actual, but you can use budget also. Subtract the break even right here. And this is my margin of safety in sales dollars. Margin of safety in dollars. That is equal to 225, 100. Okay, so expected margin of safety. We can also do the margin of safety in units, right? Do they tell us how many units they have sold? No, they don't tell us how many units they have sold, right? So we can't make any guesses about that because they haven't given us units. And then what is their margin of safety if sales revenue was $500,000? So margin of safety in dollars. And they're saying, well, what if their actual was $500,000? And we're going to subtract the 450,200. Our margin of safety will have shrunk. It'll become smaller. And that indicates we have higher risk, right? The risk is that, let's go back to the chart. The risk is that we're falling down and we're ending up in this loss position right here. This is a pretty decent margin of safety, right? But if we were way down here, we had much smaller margin of safety. So that's what's happened here. We have a much smaller margin of safety. We lose $49,000 of sales, we're going to be in a loss position. Here, if we lose $225,000 of sales, we're going to be in a loss position. So we're in a much stronger position.